In this video, we're going to cover a trailing stop strategy I call the 2-5-1 trailing stop strategy. And we're going to go through the definition of the strategy, how to set up the strategy on your trading charts, and give you some examples of how this strategy works in action. So the purpose of this trailing strategy, and for all intents and purposes, in this video, we're not going to be talking about setups whatsoever. We're going to assume that you have your own chosen set of setups you're going to use to enter the trade. But we're simply going to be talking about today, and in this video, is this idea of trailing your stops and how to manage winners and letting them run. So this strategy is what it's very good at, is it allows you to systematically trail your stops in sort of a mechanical fashion that requires very little decision making. At the same time, it really allows for winners to turn to big winners while capturing those winners once they start to get very, very large without giving a lot back. So let's get to the actual definition of the strategy and what does it actually mean by 2-5-1. Well, 2-5-1 stands for trail for 2, till 5, then 1. And this is all based upon the calculation of risk to rewards. So what we're going to do in this strategy is calculate your risk to reward. We're going to call that 1R. And then we're going to trail our stops for 2Rs until the target hits 5Rs, or 5 risk to rewards, which at that point we will then trail by 1 risk to reward. So for instance, and I'll explain it now, but it'll become a lot more apparent when we get to the actual examples. If I have a position that gets to 6R, or 6 reward to risk ratios, that means I'm based upon the amount of risk I'm taking, 1R, my position has moved to 6Rs. Then at that point, I would trail my stop to 5Rs. So I would never lose or stand to make less than 5Rs on a 6R trade. Okay, let's say the position got to 4Rs, so 4 reward to risks. Then I would trail my stop to 2Rs. At that point, I would never make less than 2 risk to rewards. Okay, so I hope that helps you understand that at a high level. Let's now talk about how to set it up, and then as I said already, we'll get into some examples which will really clarify things if you're not following along. So how we determine our risk or reward to risks is by simply drawing in those R lines by using a tool called the Fibonacci price retracement tool. Some people call them Fib grids, Fibonacci grids. And they're going to be used to calculate our risk to reward lines. So the Fibonacci tool can be used to extend or project. I guess extend is probably the better word, as we're not using projections here, to extend out your risk to reward lines. So it's important to note that what I'm going to be showing you here today in terms of screenshots and how to set it up is through the charting platform tradingview.com. If you use a different charting platform, then some of the settings may look a bit different, but certainly pretty much every single charting platform nowadays has the Fibonacci price retracement tool baked inside of it. So if it looks slightly different on your platform, then I would advise you to consult your platform's documentation on how to set it up. Okay, so let's get to the setup of it. Pretty straightforward. You're going to open up the settings for your Fibonacci retracement tool. Again, it's the Fibonacci price retracement tool is the one we're looking for, not the extension tool, not the Fibonacci timeline tool. We're talking about specifically the price retracement tool. That's the one you open up. It typically says 0%, 100%. There's usually a 38.2, a 61.8, a 78.2, a 127.2. Those are the default settings, but we're going to change them, and we're going to set them as follows. You're going to keep your 0 line, you're going to keep your 1 line. You're also going to put 2, 3, 4, 5, 6, 7, 8, 9, 10. That's that's usually about as far as I go, is about 10, because you're talking about 10 R's. So these are literally drawing 9 or 10 R's in your charting platform. Okay, so take a look at that screenshot and change your values to match those. All right, so let's go over some examples now and on how you draw this on your chart. Okay, so in this example here, and once again, as I prefaced in the beginning, in this set of examples, we're not going to be concerned with the actual signal. I'm using I'm using a bar, a price pattern to get into these setups. Again, yours will be different, but you can apply this trailing stop strategy to any open position. So in this example here, I'm drawing the Fibonacci tool on this particular bar, the one I'm highlighting and I'm pointing to right there. And how you draw it is you draw from the low to the high of the bar, and that will then create these these extensions. All right. So the length of this bar is considered 1 R, 1 reward to risk. You'll note that as the price moves from 1 R, and you can take this and add it on top, that's now 2 R. All right. We take the same length of this bar and add it to the top of that, and that becomes 3 R, and so on and so forth. And so the strategy is 2, 5, 1. Trail by 2 till 5, then 1. So how this works in actual play is as follows. So this is my setup bar, and I would enter in the following bar. So this bar here would be the bar that I enter right about there. Now I want to trail my stop. Wherever you put your stop is up to you. Initially, I have, depending on what strategies we're using here, we will have different places to place our stop. But again, the rule is as follows: 2, 5, 1. So in the beginning, once the target gets to 2 R, or once it gets to the 2 line, we're going to trail by 2, right? So this is the first. Here's 1 R. This is 0, right? This is the 0 line. We're going to count to 1 R right here, right? So once it hits the 2 line here, or 200%, we're just going to call it the 2 line from now on. We now move by -2. So we're going to bring it up to par now, right? So 2 minus 2 is now 0. And so now we pull our stop to this area here. So right. So now we're risking -1 R. In this case here, the price goes even higher, and it hits the 3 line, which is 2 R. Right, so count it if you want to count with me. 1, 2. Right, so that's 2 R. That means 2 reward to risks. Right, so if I'm betting $100, that's the risk I'm betting. Then with 2 R, I've now gained $200. So 2 R. Now we're 2 R, or the 3 line. We're still trailing by 2. Right, so 3 minus 2 is 1. So you move this stop from here to the 1 line right there. Okay, price pulls back. The good thing with this trailing stop method is that it keeps us in. It gives the price action a bit of leeway to sort of do its thing, and then it goes higher and it hits the 4 line right there, right, which is 3 R. So now if you bet again $100, you're up $300. Okay. At this point here, we move our stop, right? So the 3 line, we move it to, we're at the 3 R, so we're going to move it to 1 R. Right? So right here. Okay. It just barely kept us in. The price action just, kind of wiggled around. It kept us in the trade. And it goes higher, and here it hits the 5 line. Right there. Right? So now we move our stop to the 3 line. Right here. Right there, right? Now, a few bars later, it hits the 6th line, which is 5 R. So you risked $100 again. You're now up to $500. Right? And now that it hits the 5, we trail by 1. So we move our stop from the 3 all the way up to 5. And here, as the price retraces, this is where we would have got stopped out. All right, so this bar here. So the price, the open position made as much as 5 R at one point. We end up capturing 4 R. So $400 on that $100 worth of risk. Let's go through a few more examples. Okay, in this example here, similar type of setup. I'm drawing the price retracement on this particular bar, okay, and I'm assuming I'm getting filled on this bar here. So right away, the price moves to the 2 line, right here. So that immediately at that point, I move my stop to this area here, right, the 0 line. So 2 minus 0, 2 minus 2 is 0. Okay, now the price goes up, comes back down, and then it comes up here, and it touches the 3 line. So this point here, I move my stop to the 1 line. Goes higher, and it doesn't go any higher. It never hits the 4 line, and price promptly goes down this way, and we would have got stopped out in this price action here. Okay, so this trade went as far as about 3.2, or I want to say, sorry, 2.25 R, and we end up getting out for par. So no harm done, right? Par meaning break even. Okay, so no harm done there. So we're looking for large runners with this trailing stop strategy, but also protecting our downside risk. Okay, next example. Here's our another play here. We draw our fib grid on this particular bar right there, just so you see. This is the bar we would have got filled on or entered in. Let's in this example. I want to let you know that. Now let's trail our stops. When this bar here closes and touches the 2 line, we now trail for 1 R, right? So we put it right there. Okay, it hits the 3 line right on this bar here, and so we trail it up to the 1 line right there. Now, and this bar hits the 4 line, which is 3R, right? And we trail it to the 2 line right there. Okay, this bar here actually blows through the 5 line, but as soon as it hits the 5, we're going to trail to the 3 line right there. It gets to the 6 line, and now that's 5R. Right, so the 6 line is 5R, so now we trail more aggressively, and we move our stop right to the 5 line, right there. Okay, now it goes to 7 on this bar. We get aggressive, we move to the 6. This one shoots up to 8. As soon as it touches the 8 line, we trail to the 7 line. All right, it goes up to the 9 line. We trail up to the 8 line, and there we would have got stopped out as this bar comes back down and stopped us out. So we let this position run to 8 Rs. So again, on a $100 risk, it would be an $800 profit if you had captured right to the 8 line. But with the trailing stop, you got 7R, which is still like an exceptional trade. Okay. Another example. So in this case here, this is the bar that we drew the risk to reward on. Okay, so all we're using this price retracement tool is to measure the amount of risk we're taking. So whatever pattern you're using, or signal, or area you're using to identify your risk to reward, you would draw that in using this price retracement tool, and then project out, right? And then project upwards or extend upwards to see how many risk to rewards this the setup has the potential of capturing. So in this case here, we'll walk through it, right? So when it hits the 2 line, which is right about there, we move our stop to 0, to the 0 line, which is right about here. Okay, here hits the 3 line on this bar, right? So we move from this area here to the 1 line. Okay, so at this point, we've now, the worst we can do is we're going to par out to a break even. Comes back down, we have lots of room for it to move still. Comes back in, consolidates, and goes up to the 4 line right there. At the 4 line, we still scale or trail by 2. So we're now got our stops here at the 2 line. Here, it hits 5, that's 4R. When it hits the 5 line, right, we still trail by 3. Now, when we're at 6R, which is right on this bar here, this area here, we now get more aggressive, and we scale our stops by 1, or trail our stops by 1. Okay, hits the 7 line here. On this bar, we trail the 6, and it goes to 8 here, and we trail to 7, and here we would have got stopped out on this price action there. Okay. Let's do one last example. Once again, using the price retracement tool to draw in our risk. In this case here, the risk is the size of this entire bar. This bar here is our unit of risk, 1R. Okay, so let's do one more time. Goes to the 2 line on this bar. We trail by -2, so we now move our stop to 0. All right, so you're risking 1R here. Now, when it hits the 3 line, which happens right there, around here, you could argue, then, I'm just eyeballing it here, then it comes back in, and we move our stop to the 1 line, which is right about here. All right, this one goes to the 4 line here. The 4 line, we move our stop to the 2 line, and you can see it probably just barely kept us in the trade. Very, very close, but I think it would have kept us in the trade, just barely. All right, it consolidates a bit, shoots higher, it gets to the 5 line here, right around this area here. At that point, we're still trailing by 2, so we moved our stop now to the 3 line. Now we go up higher, and it hits the 6th line, which is 5R. We get aggressive. We now trail by 1, and we would have got stopped out on this action here. We're trailing by 1 here at this point, from here to there, all right? And this price action would have stopped us out for a plus 4R trade. All right, so I hope you understand now what the definition is of this trailing stop strategy, how to set it up, and then how to actually apply it in your trades.